Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Today, we continue our webinar series surrounding COVID-19 and the global pandemic's effect on the automotive retail market. Before I introduce today's presenter, a few quick reminders as always. Everyone that is registered for today's program will receive a copy by next week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Today, we welcome back Tom Contos, Senior Vice President and Chief Economist at CAR Global. Tom, it's been a while. We've missed you, so I'm going to let you take it away.
Thank you, Rachel. It's always a pleasure to speak with the dealer membership and associated members of the folks at AIADA. So thanks for the opportunity. We'll be going over the area of specialty for an economist like myself that spent as long as I have in the remarketing industry on today's wholesale market. So that's our topic today. I'll just go ahead and come right into the slides here. Now, I didn't put a mask on for the meeting, so forgive me, but I did put a jacket on, as you can see from this picture. So I'm glad to be part of the presentation. But let's go into the numbers, which I enjoy sharing a lot more than pictures of myself. So starting with really sort of a higher level, because really everything that happens in both the retail used vehicle market and of course the wholesale used vehicle market stems from the ability of consumers to make payments on new and used vehicles. And that ability stems from being employed generally. You know, paychecks help consumers make payments. So the lack of paychecks that we're seeing right now is one of the limiting factors to any enthusiasm we might have for a recovery in retail sales and wholesale sales and used vehicle values, both at retail and at wholesale. But thankfully, the market's been surprising to the upside. But again, the limiting factor ultimately stems from having as many individuals that have had to reluctantly, I would assume, file for unemployment insurance. And that's 41 million people now, very close to 41 million people. You can see the 10-week trend here in this first slide. On the right-hand side, you can see that the rate of worsening may be lessening, but it is still at 2 million plus unemployment insurance claims that were made just, in the data that was released this morning, which we do get every Thursday. That 2.1 million is many, many times what we were seeing in unemployment claims prior to the COVID crisis. Typically, as you can see from the left-hand graph, you're in the hundreds of thousands, not in the millions. And even at peak levels, you stay below a million, at least we have, even in such dramatic periods as the financial crisis or the Great Recession in 08-09, and then post 9/11, and other times, even the peak ever, the previous record had been just under 700,000. So that just puts this in perspective. Everything we've been trying to do as a society, where at the present time, we're kind of favoring lives over jobs. So we're making a sacrifice in terms of jobs in order to make sure that this pandemic doesn't worsen in a way that's uncontrollable and causes many deaths. So that's been the case. But everything we've been doing really in that effort, and sort of the aftermath of that effort on the economy and on even things such as wholesale prices and wholesale volumes, has to do with flattening the curve. We hear that from Dr. Fauci, and that's sort of the concept. What can we do to limit the damage? So there has been some flattening of the curve, if you will, that's depicted here in the reduction in the number of unemployment claims. but it's still at, as I say, alarmingly sort of high levels. But let's move on to some positive news here in terms of retail sales of used cars. The left-hand side of this shows, based on Car Global's driven data sciences data, we're able to look at listings and delistings of vehicles on websites and determine from that at least a good proxy for what retail sales activity in the used car space is how that's going. And we can see that there's been a good uptick since around early April in retail sales of used cars. You can see that from the blue line depicting 2020. And you can actually see that we exceeded the similar period in late May in 2019. Now, we haven't quite gotten back to pre-COVID levels because the used car market was going great guns up till the first week of March or so, when that blue line started to descend. But we're getting very close to reaching pre-COVID levels in terms of retail sales. Now, there's portions of the market that aren't feeling this kind of an increase. This data is maybe skewed 75-25 towards franchise dealers versus independent used car dealers, which are a very important constituency at auctions and also a very big contributor to the used car retail selling footprint in the U.S. But be that as it may, because it's more like a 50-50 split in terms of retail sales between franchised and independent dealers. But this is good news, and it is helping. You'll see as I proceed through this, you'll see that there's been good headway made in improving auction volumes and auction prices based on the strength of retail sales. And the lower graph here also shows that the inventories that were building up pre-COVID and then post-COVID, at least in the early stages, those inventories have now been worked off. And so there's fewer days of inventory. So there's a good thirst, if you will, for additional inventory at auction to replace sold vehicles. And again, that's good news, and that's driving the retail demand side of wholesale market trends right now, which are fairly favorable, relative at least to the earlier stages of the COVID crisis. On the right-hand side, you see a map which is sort of like the real estate axiom. It all has to do with location, location, location. So we do see that there's variability to the recovery in retail sales, but the states that were hardest hit, like California and New York, are showing very positive signs of recovery. So they are still probably the furthest underwater, but they're also the more rapidly recovering of all the states probably here. As you can see, based on the this sort of heat map, you can see that the darker states represent states that have recovered more strongly, and New York is kind of in that range there. So good progress there. I'll go ahead and now talk a little bit about the wholesale market specifically and auctions. You know, there's a database I use and have used for many years called AuctionNet, which is not only ADESA data, but all the major auctions in the U.S. It typically represents about 7.5 million records in an industry that represents somewhere around 9 to 10 million vehicles sold. So it's sort of the 80-20 rule in terms of coverage. So by looking at the volume going through auctions per that AuctionNet database and relating it back to the week of March 2nd, which was the last full week, and it was kind of a strong spring market week, sort of a precursor to what we would normally see at tax time in normal years. If we sort of make that our 0 point, you can see that by March 30th, wholesale volumes were at at 16% or an 84% drop from the first week of March. But we see a little bit of a Nike swoosh here in that wholesale volumes have recovered and are now at about a third down versus being more than 80% down. So good recovery there in terms of volume as our industry has carefully, in sort of a simulcast only mode, so an online only mode largely, no physical auctions to speak of, although that's gradually changing, but still kind of in its infancy and very sporadic geographically. So largely online only. So what's not really shown here is the conversion from, a blend of online and in-lane traffic back on March 2nd to an online only that's only, 33% down or 34% down from those levels. So that is a real testimony to the evolution of our industry, the very rapid evolution of the remarketing industry, and for dealers and sellers and buyers, consignors and buyers who have morphed into this online only environment in a very favorable fashion. And looking at that split of the volume by three major categories that are available from the AuctionNet data. There's the dealer category, which of course to those on the phone and online right now checking this out, you'll see that the dealer volumes haven't recovered. As sellers, dealers haven't recovered quite to the same degree perhaps as we've seen for fleet lease consignors, and that fleet lease category represents anything from commercial fleet units to repos to off-rental risk units, and to some degree, some off-lease volumes sold by non-captive sellers. So there's quite a bit of variability there, and actually the captives in many cases are also represented. If they're not selling in kind of a closed environment, they're represented in this red line as well. But that red line has gone more V-shaped, or at least a little bit of a downturn the last week or so, but still very healthy recovery. Still down relative to pre-COVID, but good recovery there. And then also the factory volumes, as we like to call them, sales by manufacturers, usually in closed environments, those have recovered pretty well, especially as the market has improved and manufacturers can feel more confident that they're not selling their vehicles at residual values that were greatly different than what they had predicted 3 years earlier when they set lease residual values on their lease contracts. So it's good to see that full participation. As I mentioned, prices have recovered pretty well in recent weeks, though we may end up seeing a W here, which I'll kind of give some further evidence for as we go through this. But all seller groups have seen price increases. As supply starts to increase, which we'll talk about, we may see this down again. And that's to say nothing about what might happen as our society reopens. If there's concerns that we need to go back into some sort of shutdown mode because the pandemic is spreading again at an alarming rate, then all bets are off. But that aside, still enough supply. I believe what degree these prices will continue to improve, and I'll have, as I say, more evidence of that as we go through. But you can see really all three seller groups have done pretty well in recent weeks. That's also helped what we call conversion rates. So if 100 cars are offered in a sale and we sell 75 of them, as we were right there in early March, when I said the market was going pretty great guns right then, we're all the way back to about 68%. Now that varies a bit by seller type as well. Here I'm using ADESA data, so I can split out from the manufacturer segment. I can split out captive finance, as well as factory, as well as dealer and fleet lease. You can see the dealer and fleet lease lines there have been pretty steadily rising. Factory and captive, it's been on the basis of the strength of the market each week and whether those consignors felt that, again, if you're looking to achieve a certain percentage of residual values that were set on lease contracts, or if they're off rental program cars, you're trying to get as close as possible to the guaranteed repurchase price that you arranged with the rental company, a year ago. So there's some selectivity, if you will, on the part of manufacturers and captives that's reflected in these lines based on their willingness to accept market prices or to wait for market prices to hopefully improve and then let the units go. So that's part of what you see in the jagged lines for the captive and the factory conversion rates versus the steady lines we've seen for fleet lease and dealer consignment. So let's maybe drill down a bit into the sales price data. Again, this is based on ADESA data. We've got pretty good information these last several weeks that indicate the improvement in prices, but those prices, as you can see from this graph, are still down. So if you read from the left axis, you can see, and represented in the bars on this graph, by model year, the rate of decline relative to the first week of March. So the week of May 18th, last week, the last full week we've got, if you look at the average prices for 2019 models, they were down around $1,100 compared to those same 2019 models back on March 2nd. Now, there could be some changes in the mix of vehicles that over-dramatize some of these drops. So if you have more full-size SUVs that are 2019s being sold versus what you saw on March 2nd, that could exaggerate some of these declines. But I would say those percentages that you see here, which you would read off the right axis, and that you can see in the green line on this graph, those 5% drops are probably fairly accurate for what 2019 models are experiencing last week. Now, that number might have been 15% to 20% just 3 or 4 weeks ago. So again, the rate of worsening has declined. Things are still down, but not as down as they were just a few weeks ago. And the big question now is how much further can they continue to rise in light of supply pressure that I think is coming. But we'll take this good news. It is a good time for sellers to sell. So as dealers, when you're looking to unload aged units or unwanted trades, depending on the model year there, it's a better price environment than it was a few weeks ago. You can see, too, that there is reluctance on the part of captive finance companies and other lessors on those 2017 models. The price adjustments are only 3%. I believe that that's largely because you're not seeing the no-sale vehicles, which if they were kind of brought into this too, those price declines would probably be more like the 5% we see for the 2019 models, which, by the way, the 2019 models are largely the off-rental units, which I'll have more to say about here in a minute. But the older models, both in absolute and in percentage terms, they're holding up pretty well. And the very oldest models have actually seen price increases relative to pre-COVID. Hopefully that information is useful to you. We've been sharing, Car Global has been sharing a lot of this data with our clients to kind of advise them on their sales strategies. And we can drill down into this further than depicted here, but I hope you find these trends insightful. If you then start looking at this by model class, I haven't done this by model year and by model class because if you start splitting this data too finely, you get some sort of wild swings. But if you look at, for example, full-size cars, 40 cars, and let's focus in on the full-size pickup, the third bar from the right, I think, if I'm saying that right. There's a bit of actually a $2,000 gain or a 14% gain relative to the first week of March. So prices have actually gone up for full-size pickup trucks. And that's probably not too surprising to the dealers on this call because that's been a segment of the market that's just done really well, especially on the new car side. But when new car sales are brisk, a lot of times that will support used car values for pickup trucks too, because there's just demand out there for these types of vehicles. Though the incentives you would think would be pushing down pickup truck prices, just the sheer availability of pickups, which are a bit more of a scarcer commodity at auction than, let's say, mid-size cars are, or mid-size and small SUVs. I think that's part of what's driving the price increases there. Again, we can drill down into this more as needed, based on particular needs for folks that we are trying to advise in their sales strategies or purchase strategies at auction. The trends that I've been talking about of improving sales, you can see very clearly from this graph too. If you go by model year again and you look at our most recent week, which was the 1143 that I highlighted, so $1,100 price drop for the 2019s was something 4 times that, roughly, just 4 weeks ago. So this is the improvement that I'm talking about. The question again is whether we're seeing we'll see a steady improvement, or whether we might see some sort of downturn, or at least a plateauing in the weeks to come. And that'll be supply based. I should probably jump ahead here. So I've got a similar graph for the 4-week period for the model classes. Let's go ahead and talk about supply real quick as my time starts to run out here. The rentals, so I kind of look at the sources of supply at auction this way. I kind of go almost from youngest to oldest here. Rental cars being like a 1-year-old car typically, off lease being a 3-year-old car typically. Repos, the repos we get at auction are largely were financed initially used, although we of course get some repos from the captive finance companies as well that were originally purchased or leased new. And then commercial fleet vehicles tend to be 3 to 5-year-old vehicles. Dealer consignment, usually those are aged units and unwanted trades. So usually those tend to be on the older side as well. But trying to take each of these in turn, the rental sales, there are, as we all know, with about a 15% utilization rate right now of the rental fleet that was on the ground when this thing hit during the spring break time frame. That's a lot of cars that would have normally been utilized in Florida and other parts of the country that have a strong spring break rental take rate. And that really, of course, went to zero very quickly, as did travel in general. Business and vacation traffic really has been brought to a standstill. So no surprise there that there's kind of a glut right now of off-rental units. And the Hertz bankruptcy, as I'll talk about in a minute, doesn't really help matters there. But longer term, there'll probably be a shortage, maybe a year or two from now, from the reduction in fleet purchases by the rental fleets of new vehicles. So, but in the near term, for sure, this is kind of what I would call a glut of off-rental units. Though, again, their prices have improved and demand for those units is good because they're a nice substitute for dealers seeking some inventory that if they're not getting quite the new car inventory that they need right now, they can substitute a nearly new off-rental or off-lease unit. So there's still good rental and off-lease demand, but there is quite a bit of supply. I would say supply exceeds demand right now. And the off-lease, we've seen a little bit of a reduction in the off-lease volumes and anticipate maybe for a while longer we would see a bit of a reduction from lease extensions. But as lessors, start saying, hey, it's time to return that lease car and come back and hopefully buy another new car, we think off-lease volumes will resume at a fairly solid and heavy pace that we were anticipating already for 2020. Repos, kind of the same thing, a little bit of a deferment of, repossessing cars during these tough times. But, lenders are going to have to go ahead and call back some of those vehicles that are in big arrears in terms of payments. And so we'll probably see some rises in repo volume. And that's probably going to continue going forward as well, as depending on the situation with the economy as a whole. And commercial fleet vehicles, those are sitting idle in large part right now as the economy's been shut down. And so probably won't see as much of the fall defleeting we would normally see. That might be a little bit of there might be a bit of a shortfall on those. And then dealer consignment units, they've been actually declining. I showed you that those volumes have recovered some, but they lag the other groups a bit. So with what little time I've got left here, I want to go ahead and talk a little bit about the Hertz bankruptcy situation, which, as you see, it doesn't really help matters in terms of supply. But again, I think we can find a home for those vehicles, and they're good retailable units in the end. If you want to try to put numbers on it, the announced rate of disposition of the Hertz fleet as a result of the bankruptcy situation is in the range of, I would say, 15 to 30,000 units per month for the rest of the year. I would say somewhere in the neighborhood of about a couple 100,000 of the 500,000 units in Hertz's fleet would likely be liquidated to right size the Hertz fleet and to raise funds to help with their situation with regard to the bankruptcy. I call this phantom inventory, and I liken it to what happened during the Great Recession when construction of new homes had ceased, but home values weren't going up because, first of all, the market was overbuilt to begin with. And then also there was supply coming in from foreclosed homes. So it took a long time for home values to start appreciating again. And I think we sort of have a similar possibility with regard to late model off-rental used vehicles. And saving grace, as I say here, is Hertz's ability to use alternative remarketing methods besides auctions so that they don't overload all their volume into one channel. But there's limits to how much of that they can do, and the speed with which vehicles can be liquidated in the auction environment. It was probably going to be important to Hertz in light of the bankruptcy. So I think that's about it for now, because I notice we're right at the end of the time for this. I do want to point out that April's data for wholesale values was the worst we've ever seen in terms of a year-over-year price increase. Now, when I have my May data, and I issue that in my Contos commentary coming up, once May closes, we'll probably see a lessening in that rate of decline, as we've seen in the other metrics I've shown today. But for the record, April was the biggest decline we've seen on a year-over-year basis in any single month through not only the 20 years shown here on this graph, but through the roughly 30 years almost that the AuctionNet database goes back to 1994. So with that, I better close up and let you know that if you've got any questions about today's presentation, feel free to submit them. I know Rachel will kind of make sure that I get them, and we can take it from there. Thank you. I'll turn it back over to you, Rachel. Thank you.
Tom, thanks for speaking with us today. This is really great information. Again, to those on the line, you'll be receiving a recording of this webinar by early next week. To continue our COVID-19 webinar series, join us back here on Thursday, June 4th at 2 p.m. Eastern as Cox senior economist Charlie Chesbrough returns to give us an update on COVID-19's impact on U.S. auto sales for the closed month of May and beyond. Be on the lookout for promotions on how to register. For more information about AIADA, visit AIADA.org. Thanks for joining us and have a great day, everyone.